Hello, traders. Gary Wagner here. It is 1 o'clock in Honolulu, 6 o'clock in New York on Thursday, 23rd day of February 2023, and this is the Daily Report for Gold and Silver. Over this last week, the primary topic that we have been discussing is the fact that the recent sell-off in gold seems to be an acceptance of the Federal Reserve's new narrative to continue to raise rates, to keep them elevated throughout the entire year, which did not happen overnight. In fact, I noticed that it was a process or a set of stages that got market participants to disbelief to acceptance. I realized that market participants went through steps of disbelief to eventually acceptance, and I was also aware that it closely tied to some of the same processes that go through anyone that is overcoming grief. So I asked the question to OpenAI system chatbot GBT to see what the response would be. That response is the opening letter, and I think that there are some insightful parallels that we can draw from the answer from this AI platform. Gold continues its dramatic price decline, giving up $11.90 today, or 0.65%, with the most active April contract currently fixed at $1,829.60. That occurred with only fractional changes in the dollar. The dollar gained 0.04%, in essence unchanged, and the dollar index is currently fixed at 104.565. Lastly, silver continues to have strong declines, giving up 1.65% today, or a total of 35 cents, with the most active March contract currently fixed at $21.32. The idea that I presented today, and that is that acceptance of the Federal Reserve's tight monetary policy occurred over a period of time through a process of steps in which they went from, in essence, denial to acceptance. What was most troublesome is observing gold prices at the end of last year and the beginning of this year, because in December, the Federal Reserve came out and announced an extremely aggressive revision of their monetary policy. They had already raised rates from, in essence, 0 to 4.5%, and then announced to the public that there would probably be more rate hikes, and those elevated rates would remain for the entirety of 2023. At the same time, we witnessed gold move from November's pricing at just above $1,600 through a sharp period of rallies with very, very small corrections until it hit its highest value this year, right above $1,970. In other words, the movement of gold to the upside didn't match the sentiment that the Federal Reserve was expressing, because raising rates is a bearish force upon gold, and yet we saw gold continuing to move higher. My only explanation for that was there was either disbelief or the assumption that the Fed would back off of that extremely aggressive and hawkish stance. However, that all changed a couple of weeks ago after hitting this high, and we've seen gold decline from about 1970 down to its current pricing, which is coming in around 1932. As you know from previous shows, I'm looking at a line in the sand at around 1900, because my sense is that on a technical basis, we need to see a continuation of higher lows as well as higher highs to confirm that we're still in a bull market. If in fact this correction results in a break below the most recent higher low, that would negate that assumption on a technical basis. And so that is why I actually looked at the possibility that it was a series of steps, and very similar in many ways to the steps to overcome grief. I know that this topic was far away from my usual way of covering the market, but I felt that it merited the interest in me and hopefully the interest in our subscribers. This has been Gary Wagner wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.